Oh man, SoFi is about 40% down from all-time highs and it's taken a beating over the last week or so since their earnings. But why? And is SoFi a good investment and should we be building a bigger position in SoFi? Let's take a deeper look. So SoFi are currently trading at 14.04. They're 1% down in the pre-market at the time of this recording. We're sitting at 14.2. Now, if you look at this, if I move myself out of the way, you can see we've come off highs of 25s, we've hit 23 again, and now we're sitting at 14. Is this a good entry point? How are SoFi getting on a fundamental basis? That's what we want to address here. And for those of you who aren't familiar with what they'll do, we'll touch on a little bit of that too. So what is SoFi's mission? So SoFi say they want to help members achieve financial independence to realize their ambitions. And they use the term their HENWS. So what's a HENWS? You'll see in the small print, they've defined it as high earners not well served. So that's their target audience. That's the kind of people they want to address. Now, when we look at when Chamath Palihapitiya announced that he'll be taking SoFi public via the SPAC merger, IPOE, in January, he said the following. He said he wanted to find out what was broken with the banking, the existing incumbent banking we have. And he said it was the following. He said, 1, people want low to no fees. He said, 2, they want fair and transparent lending. And 3, he said they're looking for a one-stop shop with a full suite of products. And what he really liked about SoFi was their strong potential to upsell and cross-sell. And that's what we want to look at here, because it seems like they've created a hub and spoke model with all these different opportunities, and they want to get people in and then upsell and cross-sell. So they operate across a few different segments, which they've put here in their financial presentation. They categorize it as lending, which includes their student loan refi, personal homes, in school loans. They then acquired the technology platform Galileo. So Galileo was bought in, I think it was for 1.3 billion last year, but I think it's been a good acquisition. It's probably valued at about 3 billion now. And then they've got their financial services, which is SoFi Invest, SoFi Money, credit card, etc. Now, as you can see, they've created this hub and spoke model. Okay, so what they're saying is once we get you in through finances, we want to be able to serve you for all your finance needs. You shouldn't need to have an account with JP Morgan and then somebody else just to do different things. You should be able to do it all through one interface, which is SoFi. So you can see here they've got money, invest, personal loans, credit cards, home loans, student loans. They really want to cover the lot. Okay, that's the model they're going after. And Chamath also spoke really highly about the team they have, the senior investment team they have. So you can see it's headed up by Anthony Noto, who was COO at Twitter. He was also CEO at the NFL and worked at Goldman Sachs too. And then beneath him, he's got some real credible people underneath, from backgrounds such as Uber, Goldman Sachs, Amazon. It's clear he's built a good management team. You'd come to expect this for a company going public. Now, let's look at the members growth. So SoFi is sitting at 2.6 million members as of their latest reading, which was their Q2 2021 earnings. And that represents 113% growth on their Q2 2020 figure, 1.2 million. Now, you can see the growth from 2.2 there. So it's a good growth, but it's not quite exponential just yet. It's getting there. It's good growth, but we'll probably want to see that push on a bit more. And the reason for that is the following. Let's look at some comparable apps. And we know these are all different. They have slight differences in their products, but these are probably some of the closest companies I thought we could compare. So what I did was I wanted to look at 2 key performance indicators for these types of companies. One is your monthly active user, because ultimately, if they're active and they're transacting, that's where you're going to make revenue for all these platforms. And then 2 is the average revenue per user. And this is a really important metric because once you get them into your ecosystem, you want to make sure they're staying with you for longer and longer, i.e. the lifetime value, and they're spending more and more. So Square Apps seem to suggest they have 36 million monthly active users, and their average revenue per user is estimated at $170. Now, let's compare that to Coinbase. They're sitting at 8.8 million, and they've got 253. Okay, so they're sitting at $253 per user. Now, Robinhood, in their latest figures, have quoted that they're on 21.3 million monthly active users, and their average revenue per user has fallen to $112. I covered that in the Robinhood quarterly earnings breakdown. Do go check that out, as we cover that, and we can see that that's a worrying sign for Hood. Now, what have I mentioned is the key difference between Robinhood and Coin is Coin's ability to diversify their revenue lines. So what Coinbase have effectively done is through their earn and staking and other products, they've figured out how to get revenue outside of the transaction fees. And I mentioned in the video that this is a worrying sign for me for Robinhood, because Robinhood are still receiving all their money through transaction fees, which is related to payment for order flow. And therefore, you can see that they've not managed to diversify to other incomes. But if you look at SoFi with their 2.6 million monthly active users, they've got an average revenue per user of $267, which is a great sign because it's evidence, and we'll need to research this a bit more, that they are actually able to drive revenue per user up, and they're cross-selling and they're able to use different platforms. This is definitely something we want to monitor, because if they can maintain / grow that average revenue per user, whilst working to the monthly active user numbers that Square has evidence is possible in the finance space, then this could be a really interesting formula recipe for success for them. Now, the other thing is we want to get a gauge of valuation, because we can see the share price fluctuating, but what does it mean? For a fast-growing company, we can't really use earnings per share. We can't really use EBITDA multiples in much the same way. So what I thought I'd do is, as a crude estimation, let's look at their market cap and let's look at their trading 12-month revenue to get a revenue multiple. So Robinhood are sitting at 41.6 million in market cap, and their last 12 months, trailing 12 months revenue was 1.3 billion. So they're operating, their current share price, which is down from the highs, by the way, this is at the 48 mark, I think they're at, is 31 times their trailing 12 months revenue. Now, if you look at Coinbase, they're sitting at 64 billion in market cap with almost 5 billion in trailing 12 months revenue. So that's a 13 multiple, which ties in exactly with what we're seeing at SoFi. SoFi at 11.3 market cap, and they've got 852 in trailing 12 months revenue. So this is a more sensible valuation, and it's testament that these two companies are operating in a similar manner. And they both got very good potential. If Robinhood is coming in at that kind of a level, and we know there's a lot of momentum and momentum energy trading in this space with Robinhood, but the Coinbase and SoFi multiples, it's interesting that they've come out at the same level at 13 times. Now, let's look at product growth with SoFi. So you can see here from Q2 2020 of 1.645 there, you can see that they've grown the product revenue to 3.6 million. So that's a 123% increase year on year, which is great. That's what we want to be able to see. Now, flicking on to their financials, let's take a look at this. So we can see their quarterly adjusted net revenue is up to 237 million in Q2 2021. Now, in Q2 2020, they were 136. Okay, so that's a 74% increase in year-on-year adjusted revenue. Now, let's look at their adjusted EBITDA. So their quarterly adjusted EBITDA is currently at 11. This time last year, they were minus 24. They were loss-making. So they've really managed to get themselves out of a loss-making situation whilst growing revenue, which is quite interesting because for a lot of fast-growing companies, they sacrifice EBITDA and profitability to push the top line, increase their marketing, increase the product spend, increase all the OPEX, and just capture market share. But it's interesting that they've managed to turn profitable. But how does that look over the yearly picture? Because that was one quarter in a snapshot. How does it look as a yearly picture? Well, the same thing applies to here. Because in 2020, they did 621 million in revenue, but in the last 12 months, they've done 852. So remember, the last 12 months is simply using Q2, Q3, and Q4 from 2020, right? So it's Q3 and Q4 from 2020 plus Q1 and Q2 from this year. So all it's saying is Q1 and Q2 this year was 230 million more than Q1 and Q2 the previous year in 2020. So that's tremendous growth on their revenue. Now, has that equated to EBITDA? Yes. Again, look at 2020. They were making 45 million loss in 2020, but the last 12 months, they've pushed that to a 61 million positive EBITDA figure. Okay, so that's almost 100 million swing in EBITDA. Now, caveat it, we have to take this with a pinch of salt. These are not gap figures. These are just the EBITDA figures shared by management on their investor presentation. But I can tell you from experience, from a management point of view, we have to look at these as investors. We have to see the business in the eyes that the CEO and the management team are looking at it in, because that's how we're going to believe in the company. That's how we're going to understand where they're going. No doubt we have to have critical analysis. We have to look at their gap earnings and their filings, but we also want to understand the fundamental around the target audience, the target market, what opportunity they're going at, and how do they feel they can best serve that target demographic. So let's take a quick look at where their earnings came in, because we want to understand, why are we 40% down? What went wrong? So in their Q1 21 earnings presentation, they indicated some guidance. They said revenue would be between 215 and 220 million. Now they came in at 237, so they beat their high end. So that was an 8% beat on the high end and a 10% beat on the low end. So what's the concern there? Now, on adjusted EBITDA, they guided that they be between minus 8 million loss to a plus 2 million loss. They came in at 11 million positive. Again, a 4% beat on the high expectation and an 8% beat on the low band of the expectation. So what went wrong? We want to understand how did we end up with 40% down and 20% in the last week or so? Well, that's where this bit comes into it. And they said in the third quarter revenue guidance, they moved it from 245 to 255. That sounds good, right? They've increased their revenue guidance. But no, the estimates were 270 million. And that's where we come into, guys. Because for a fast-growing tech company, a growth stock, we want to see beats on earnings. That's a given in this market. Look, given the market we face this year, that's a given. You've got to beat on your metrics. But we want to see improved guidance, let alone changing guidance to the downside. And I think that's where we're seeing this stock getting hammered. Now, given the climate we're in, the uncertainty around tapering with the Delta variant, various geopolitical concerns going on, it's a tough time in the market anyway. SPACs are getting hammered across the board. There seems to be a rotation away from SPACs. And that's probably leading to some of the weighing down on SoFi's price. But the question we need to have is, where are we at in terms of understanding SoFi fundamentally? And I'll be honest, I'm not fully there yet. I've started nibbling on SoFi shares. I'd probably nibble a little bit more now, but I'm not ready to go in with a sizable position on SoFi. I've got some more learning to do. I want to understand this business a little bit better. And the area I want to understand is around their average revenue per user and their ability and evidence that they are able to cross-sell and upsell. If we can get that over the next few quarters, I think that then bodes well for SoFi and where it's heading. It's clearly a great company. It's a great opportunity. Nobody's kind of democratized that finance space, particularly in the States where it's very fragmented and people have to use so many different providers. It's a great idea to have a one-stop shop which covers off all those things. The management team is solid. The members' growth is solid. The snapshot of the average revenue per user looks good. So it's definitely a good stock. It's just currently anything with a bit of a retail name or a YouTube stock is just getting hammered. So that's why it's important that you do your research from a fundamental basis, so you have solid conviction and you don't become one of those who panic in the downturn and start selling. You should be confident enough to average down because you've studied it enough. Your conviction is high enough that you believe in the company for the long term. Your mindset should be, I've bought some SoFi. I'm not going to look at it for 5 to 6 years, and it should be a winner. All right, not quite there, but I've got enough of a conviction level that I can start nibbling. So there you go, guys. A breakdown of SoFi and whether it's a good time to buy. Hope that was helpful. We'll see you in the next one.